I am assuming that you are now clear with the concept of simple and the compound interest rate. Now let's shift our focus to understand the difference between nominal and effective interest rates and the relationship between them. Until now, we have been talking about interest rates as in nominal terms. And it turns out that when we were compounding on intra-year basis, the effective interest rate, that is the interest rate which actually was earned, it tends to be higher than the nominal interest rate. So typically nominal interest rates are quoted in terms of annual compounding. So this you should take note that they are compounded in terms of annual compounding. Okay, on annual basis they are compounded, and they are also, I mean, this is jargon again, they are known as annual percent rate, APR. Okay, while for effective interest rate, it implies the actual return earned, and it's known as effective yield or effective annual rate. Again, these two are the jargons which you will be encountering across different resources in economics and finance when you will be reading books or even in the news media, etc. All right, so we will use the same formula which we have been discussing in our previous discussion to compute the relationship between the APR and the effective yield, and which is also called as effective annual return, like I have already mentioned, right? So this is the effective annual return. So we have this formula: 1 plus effective annual return is equal to 1 plus interest upon the and again the period of compounding raised to the power n, right? And what would be the effective annual return? So it's simply, right, expressing interest rate in terms of the yearly interest in the frequency that corresponds the frequency, right? The frequency that correspond to the case, and compounded the number of period that correspond to that frequency. So when we have intra-year compounding, the effective rate, okay, so this is a key point which you should note, that in case of intra-year compounding, okay, the effective rate will tend to be higher than the annual percent rate that is quoted. Okay, now why so? Let's try to understand with the help of an example. Now let us compute the effective rate of an investment which is offering 12% interest rate and is being compounded monthly. Okay, so here what we have is that we already have APR, or the nominal interest rate, of 12%. Okay, and in the formula, if you recall, that we will be using this in terms of 1, right? So the effective annual interest rate, okay, or the effective annual rate in this case, which is equivalent to the monthly case, right? I mean, the monthly rate is going to be there because it's being compounded monthly. So the effective rate will be what? We will be simply plugging the values to this formula and calculate. I request you to pause the video and try to work this out, and then I'll be discussing the answer. So let's see the answer. Now I'm assuming that you already have the solution. So simply plugging those values into the formula, because we had that monthly compounding frequency available with us. So our expression simply was 1 plus 0.12 upon 12 raised to the power 12, right? And this would have given us our interest rate value, right? The effective rate, right? And what turns out to be the answer is 12.68, and definitely 12.68 is greater than your annual interest rate, which was given as 12 in the problem, right? Because our nominal interest rate was 12, now our effective rate turned out to be 12.68. So our effective rate, okay, so our effective interest rate was greater than nominal rate, right? So that's why we have been emphasizing on that expression which we have mentioned. So this is about the example, and likewise if it increases to daily basis, right, if the compounding frequency is daily, the frequency increased, it's going to go further up. So as the frequency of compounding goes up, so you will be having a greater effective rate as compared to the nominal rate. All right, so this is about how it works in intra-year compounding.